panelists. What is okay? So Houston, we have a problem. Tell us more about the problem. What can the Fed do? What can we expect? Like
They can't do
they're just
anything.
running out of options. Like we're fucked. Like we said, we have to accept structural inflation, higher structural inflation. Jay, who'll be joining us in a bit, disagreed with you. Some other panelists disagreed that we don't have to accept. I think Mr. Wolf disagreed. Robert Wolf disagreed as well. I can't remember. That we should not expect higher structural inflation. That we shouldn't expect it. The chairman was pushing back on this pretty heavily. Um, it seems inevitable, but let's say the CPI numbers are higher than
Right.
expected.
But,
Then
but
what do we do then?
let me clarify. Hold on one second. There is target 2% or twos. There is structural inflation that I talk about, which is long term that we can live with in the 3 and 4s. We cannot live with the 5s. So I need to clarify that, Murray. When I talk about structural inflation, I don't mean the 5s. The 5s is the problem. The 5s will not get, will not get off our back. Central bankers will continue to be forced to tighten. I'm talking about 3s and 4s, which is what I'm hoping we're going to get today. If we get that today, we're not off. We're not off to the races. We just give impetus to that tug of war where the markets, the world will start to say, you know what, Powell, we love you, buddy, but the markets are right. And in the face of debt ceiling and all these crises, etc., the markets will ultimately be proven right.
It's not Houston. It's not Houston we have a problem. It's New York we have a problem. If you look at what John Williams said at the New York Economic Club yesterday. So we've got a Fed president out there from the New York Fed yesterday talking about how, or maybe this was Monday, but just earlier this week, he was out there because we have a variety of Fed speakers this week, and he was out there saying, look, hey, rates are going to continue to increase if inflation doesn't come down. So, you've got Fed presidents basically supporting future hikes if this number doesn't come down. So I totally agree that we need this number to come down.
Can we sustain? But what happens? Can we sustain more hikes? Like the system, the cracks are showing. There's worries in the system. Can we sustain more hikes?
I'm not the game maker. I'm just a paid observer. And I think that you're going to continue to see the cracks. And you saw it not just in the Sluice report, which I think was a great call out, but you saw it in the NFIB numbers this week as well, the National Federation of Independent Business. I mean, we're starting to see these small businesses, which, there's not a ton of economic indicators around small businesses. That's what makes the NFIB numbers every month kind of interesting to watch. But they're talking, you can see it in what they're saying in their survey as well. They're seeing that the credit is tightening. They are increasingly concerned around their future sales growth. That was something we called out this week. They're seeing actually their expectations for sales to drop precipitously actually in the next 3 months. So I think you're going to see it first in small business more than you'll see it in kind of big business. But yeah, absolutely, you're going to see cracks in the economy.
Yeah, it's cracks in the economy. It depends where, because the economy is looking relatively solid. Job and wage numbers are still hot. When is that going to change?
I mean, employment historically is last, right? So unemployment is, the lowest right before a recession because it's the last to go, which is why we watch not just the employment numbers, but also job openings, which of course has been coming down, as well as jobless claims. So, and that has been creeping up just a little bit. There's some debate about it, but it's been creeping up just a little bit as well. And then, of course, we look at the Treasury data, and we think the Treasury withholdings data as a proxy for employment is starting to show some normalization as well. We don't think that the employment market is as hot as everyone thinks it is.
What are the trends in terms of the unemployment numbers? So has it? You talked
this
about
last this last week Friday, we saw like a big print on the overall non-farm payrolls report, which is kind of the big headline number that the Fed uses and looks at in their summary of economic projections and their conversations and their speeches. However, what was probably widely overlooked was the massive revision to the numbers on the seasonal adjustments in the prior 2 months. So we don't, again, we pay attention to that number because you have to be relevant, but we think that there's other indicators to the economy that are showing that employment softening.
Okay, and if we look at the Fed, if the Fed keeps depending on lagging indicators, could they overcorrect? Um, I'm just worried, like the Fed using data from a month ago when petrol was more expensive to make decisions today, when petrol's cheaper. Could that backfire?
The Fed always overcorrects. Like every single person up here would tell you that. The Fed always overcorrects because they're always using lagging data as their guidepost.
Exactly. Exactly. They overstimulate and then they over tighten, right? It's a very simple process, right? So, yeah, I mean, we could obviously dive into that a little bit more. Neely, I actually wanted to chime in really quickly on the labor market data because I agree with you that there seems to be some overlooking going on with respect to the revisions for the prior month data. But I actually think one of the most overlooked components from last week's NFP data was the fact that prime age labor force participation is now above the pre-COVID levels, right? So this is the labor force participation rate of people between the ages of 25 and 54. It's now at 83.3%. We've fully recovered that massive decline from the COVID environment. And, this is, fundamentally really good news for the labor market as a whole, because we want to see capable people working, right? This is exactly what we want. So I don't know if you have any thoughts on that point specifically, Neely, but I mean, you're my go-to labor market expert.
You're so sweet. And you're in Budapest right now, aren't you, Caleb?
I am, yeah.
I studied in Budapest, actually, comparative economic and political systems there. So I am a fan of where you are. So go follow Caleb. He's got cool pictures. All right. So I would say on the labor force participation, our primary thesis has been this year that you would actually start seeing people come off the sidelines, off the not employed, and into that labor force, and then to try to get hired. Why? One of the big drivers is we had 17 million people lose access to low to no cost healthcare through the pandemic assistance of Medicaid. That pandemic program ended at the end of March 31. And so that is in fact what you're seeing is people coming off the sidelines and into the market seeking that component, that benefit. Because unlike other countries, the primary access for most W-2 type employed people, which is what's largely captured in the employment statistics, is healthcare. Like we don't have universal healthcare in our country. And it's extraordinarily expensive to buy privately. I've done it, I know. So you have to basically access it through an employer. And that is actually, Caleb, what we're seeing is people coming off the sidelines and into the job market. The question is, are they doing it because they want to or because they need to? So I love it that we're seeing that number high as well. I think it's the why behind it is that we're looking into.
I think one of the things... Go ahead, Monica, sorry.
No, I'll let you finish off, man. I wanted to ask Joseph a question, but I'll let you finish off.
Sure, just maybe one of the last things here on the labor market, because we also got the JOLTS data from last week, which showed a pretty considerable decline. And it's interesting because if you look at the correlation between the NASDAQ and job openings, it's very, very tight, right? So we're actually starting to see a little bit of a divergence here in the last couple of months where the NASDAQ is grinding higher, but JOLTS are still coming lower. I think one of the things that's kind of overlooked, and Neely, again, I'd love to hear your thoughts on this with respect to JOLTS, is, we're missing a lot of context about why these job openings are coming down. For example, are the positions getting filled or are employers delisting open positions, right? And we don't have the context there, which is actually quite interesting. And so, we got the JOLTS data last week. We saw the quits rate come down. That's very disinflationary overall. I've done the research on that as well. And so, I'd also be curious to hear what your thoughts are on that actual job openings number, because, to your point, right, if people are losing access to government health insurance essentially, and they need to re-enter the labor force to get health insurance, could we be seeing those JOLTS numbers come down simply because more people are coming in and filling those open roles? That generally seems to kind of fit with what we were just talking about with prime age labor force participation rate, right?
It does. Just really quickly, swiftly. First and foremost, JOLTS. I love JOLTS. Fed quotes JOLTS. We have to care about JOLTS. It is 1 month lagged relative to the labor data, as I know you know. I'm just sharing that for everybody else listening. And then secondly, the participation of the survey is like, it's gone from the 70s, like in terms of the conversion rate of the survey down to like 30%. Like the quality of JOLTS data is among all the data sets in the BLS happens to be one of the lowest right now. So I will just put that out there. So I treat it loosely because of that. Secondly, let's just say, let's hold it as a truth that what we are seeing is actually true. It's valid and it's good data. I think that the reason why job openings are coming down, and this is just comes from our own personal practice because we advise CEOs and boards on matters of the economy, it's because they're literally pulling job postings at this point because they're looking at their whole labor force and they're wondering, okay, do we actually need all these people? Do we need all this space in commercial real estate? Do we need all these people? I mean, these are the conversations that are going on in boardrooms right now. One of the first steps you need to do is actually to pull off your job openings as you go through and decide to lay off people. So I think it's somewhat of a leading indicator on layoffs.
So, sorry, Mark, did you have a question? Or shall I go ahead?
Yeah, look, I want to go to Joseph very briefly. It's kind of a separate point, Joseph. First, good to have you on the panel. Thank you for giving us the time. You know, we're looking at deglobalization increasing. We're seeing the tensions and sanctions between the US and China. Obviously, the war in Russia, costs are rising. They could rise further with deglobalization. Even though oil prices might remain, lower for now, OPEC Plus will reduce output further, towards Q3. Considering all this, can we really expect inflation to start slowing, as Wahid mentioned? Do you agree with Wahid's analysis earlier?
Oh, hey, first of all, thanks so much for having me. And Caleb, Nelly make some great points. So I agree with that
Good day to you.
idea, Mario. I think that we are really structurally heading for a world that we will have structurally higher inflation. And part of that will be because there is a structural deficit in supply. You can think of it as a shrinking workforce population because in the 1980s, people had smaller families. And so as that begins to work through the system, or workforce population is not growing as much, we see that happening already. Totally correct that the prime age labor force participation is above pre-pandemic levels. But if you look at the labor force participation for those 55 and above, that's declining, and that's not declining, that dropped off and did not come back. So we have a structural deficit in labor. And going to your point about, let's say, the reversal of globalizations, perhaps structurally less energy, that's all something that is continuing to happen as well. If we read central bank speeches, so the recent speech by President Lagarde, and I think a year ago, there was also a similar speech by, at that time, Vice Chair Brainerd of the Fed, the authorities are also becoming aware that, maybe all these tailwinds to lower inflation over the past few years, globalization, increasing supply, may be reversing. And that, I think, really structurally changes the inflation dynamics going forward. So I think that's something that's definitely something to keep in mind. And that also, I think, suggests to me that interest rate policy is going to be more restrictive than expected going forward. Depending on the mandate of the central bank, some central banks are purely inflation targeting. And if you have a world where you have structurally declines in supply pushing up inflation, they're going to try to counter that by keeping inflation higher and keeping demand in check. So I really think that we are at a point where I think the world is changing and monetary policy is going to change too structurally. It could be that we accept a higher inflation, as was suggested by higher panels, but at the US at least, I don't think we're there yet, and I don't think we'll see that under a Powell Fed. We could definitely see it under a new Fed chair in the coming years, but at the moment, it doesn't seem like they're ready for that.
So, I had a question for Stock Talk. Are you there, Stock Talk?
I am here. How are you?
Yeah, good, thanks. So I'm going to ask you a few questions on the market, but specifically, initially, obviously, market experts are saying or expecting that the inflation rate is going to be anything between 5% to 5.25%. Wahid said that he believed it was going to drop and it was going to be 4.75%.
Yeah, that which makes I'm surprised. Like, I didn't expect Wahid to be that optimistic. Like, Wahid, I don't know where he dropped out. I sent you another invite, Wahid. I see you just dropped out, but I don't know where he got this number from. So I'm really curious on why he's so optimistic suddenly out of nowhere. But sorry, go ahead with your question.
Yeah. So in terms of now,
yeah. Oh, he's up. Hold on. He's up. Before you go to stock talk, because Wahid, just very briefly before we go to stock talk, why are you so optimistic suddenly, man? Like you've never shared any good expectations with me since coming on the show.
What do you mean?
Is it making you more concerned?
What? I don't understand. What do you mean I don't have a good? I've always told you I'm bullish.
I don't know. Like I was
Have I
fine.
not?
What do you mean bullish? You're bullish because the world, like the everything's gonna capitulate, cracks are gonna become holes, and then the Fed will have to pivot. Cracks aren't holes, and the Fed hasn't pivoted.
I love how you tease me. I'm being objective, dude. They're debating on whether to default on the freaking government debt. You want
Yeah,
me?
but that's
Do you want me
politics.
to
That's
do?
not. You can't, it's not a
You
real
want me to
debate.
do
It's not a
cartwheels?
real
I know, but
debate.
you want me to do cartwheels?
No, man, but it's not a real debate. That has nothing to do with the discussion. That has nothing to do with low CPI either.
Okay. All right. So I have two. All right. So it's very easy. Okay. Whether I have optimistic expectations of missing the CPI is irrelevant. First of all, it's not optimistic or pessimistic. If we miss the CPI, it means we're slowing harder than you can imagine. Okay? So it's actually very bearish. So a bullish view is that we have hunky-dory CPI that's above expectations, not below. So that's point number one. Point number two, I'm looking at 40% of that number. People, people have been waiting for that number to come down, shelter. And they've been waiting and waiting and waiting till now finally they capitulated that we may never see that decline. We have now digested 9 to 10 months asymmetry between shelter survey and real life rental data. Okay? And you can see K Schiller, you can see so many surveys that show you the dramatic deceleration in pricing on real estate plus rent. That is what I think is seeping through as we speak. Whether it's this month or next month, you're going to finally see a reset because 40% of that CPI, which in many surveys is negative, it's actually negative as opposed to the positive in the own equivalent rent survey. Okay, if once that number finally starts to anniversary and reflect the reality, you're going to see a plummeting of that CPI number. And that's been very well telegraphed, not just by me, but many other smart people on your show, Mario. Okay, I'm the thickest of all. All right, so I'm not giving you a secret sauce. This is quite well known. But I think now is when you start to anniversary that 9-month lag effect. And that's what I'm hinging my prediction on. It's actually quite a bearish view, not a bullish.
And by the way, per the Fed's own admission and data, they've even acknowledged that shelter and owner's equivalent rent lags the actual housing market by roughly 9 months. And so, I'm in
I wish I was the
agreement here with
genius.
what
I'm not. I'm just parroting. I agree with you.
Let me give you some numbers just for the audience. So JP Morgan, so Goldman Sachs, our preview of CPI, we expect a 0.4%, 0.47% increase in April core CPI above, what is it? I can't see the rest of it. Shit, it's got it. I'll read it out in a bit. And another thing I want to read out, so that one, guys, is broken. The team in the background, the message is broken. JP Morgan, the market will react with the following, based on JP Morgan's estimates. If the CPI is above 5.5%, the S&P 500 will be down at least 3%. If the CPI is 5.3 to 5.5%, it will be down between 0.75 and 1.25%. If the CPI is between 5 and 5.2%, we'll see the market drop by 0.5 to 0.75%.
You mean it'll go up?
The market will, up will 0.5 to 0.75% if the CPI is between 5 and 5.2. Thanks, man. Now, if we get to Wahid's territory, 4.7 to 4.9% CPI, it's going to be up by 1 to 1.25%. And then CPI below 4.5%, it'll be up at least 2.5%. We'll get an update on the crypto market, how we think that will react in a bit. Ryan's on stage, Simon's on stage, but go ahead, Sliman.
Yeah, I'm glad you read that because I've got a few questions based on that stock talk. So, sorry, I was going to go to it before. But basically, I would talk about the market in general. But firstly, in terms of currency. So, we know, for example, high inflation results in currency depreciation, and that erodes purchasing power. Now, if the CPI remains the same or goes lower, as Wahid has indicated, then we expect. Then does that means the currency is going to be strengthened? I mean, is that the case? And if you can expand a bit more for the listeners, that'd be brilliant.
Yeah, I mean, I'm not really focused on the impact of CPI or inflation more broadly on the dollar. I mean, some people might be, but that's not really my perspective.